We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us today. As I say every week on the program, you can always go to the website, DeckerRetirementPlanning.com, Decker, D-E-C-K-E-R, DeckerRetirementPlanning.com, and find out more about Brian and the team. Offices in Washington and the state of California, and of course here in Utah, Salt Lake City and Lehigh. But if you want to find out more about Brian and the team, you can always go to the website. The website is incredible, a lot of great information there. But also, when you go to DeckerRetirementPlanning.com under the heading of Safer Retirement Education, there are 12 different things you can download, things about retirement. For example, Brian's book on retirement, The Decker Approach, is there. 3 Principles of Retirement book is there. The Checklist Challenge, a sample income plan, kind of how the team can help. Those are just 4 of the 12 things you can download, and there's no cost to you. It's really just there for your information. You want to learn more about a specific thing, go check it out. DeckerRetirementPlanning.com under the heading of Safer Retirement Education. There's books and useful guides, and it's all there for your ability to educate yourself on the financial world and the retirement world. Brian, how are you? You ready to go?
Good, Mark. We're going to cover a lot of great information today. We're going to cover what a fiduciary is. Many people, Mark, say that they're fiduciaries, so we're going to give a test so that listeners can find out if they really are. And then we're going to spend probably 80% of today's show on tax strategies, and you're going to want to listen because these apply to you. They are a favorite of our high net worth clients, as well as non-high net worth. They affect everybody. Then we'll talk about other strategies that are very important in retirement.
Yeah, absolutely. Because it is really about a plan, and everybody's situation is unique. And that's how Brian and the team look at it. You may come in, maybe you need $15,000, $20,000 of income a month, and you're fine. Maybe somebody needs $3,000 to $5,000 because they got a pension, they got Social Security. Everybody's situation is unique. Some people just want to stay at home, want to play with the grandkids. Others want to travel the world. All of that plays into your retirement plan. So at Decker Retirement Planning, it's about you. That safer retirement process they walk you through focuses really on income planning and distribution planning. If you'd like to learn more, you can always give them a call, 833-707-3030, 833-707-3030. There's no cost for this at all. It's totally complimentary. Brian and the team are here to help if they can. They don't know if they can help you until you reach out. It might be one of the more important phone calls you make, 833-707-3030. All right. You said we're going to start, we're going to discuss fiduciary. So right. I guess what is a fiduciary? And there is a couple ways that I guess whether you're in the insurance world or the market world, and you guys work in both of those worlds, because clients really need some market stuff. Obviously, they need growth, but they also need safety and protection. So the insurance world can come in to help guide them there. But I guess fiduciary, why do I care about a fiduciary? What's it mean?
The definition of a fiduciary, Mark, is someone who is required by federal law to put the client's best interest before the company's best interest. In my opinion, this is by far the most important decision that a retiree can make, whether or not to work with a fiduciary. Now, I'm going to go into detail on this and spend some time, but let me give you some examples of what a fiduciary, I'm going to come back to that. There's 3 checks to find out if you are dealing with a fiduciary. Many people, many bankers and brokers will tell you that they're a fiduciary when they're not. And rather than call them out, let's give them the 3 tests. Number 1, they have to be independent. So, Mark, I'm going to ask you a couple of questions. If you're with Merrill Lynch, guess what kind of mutual funds you're going to get?
Merrill Lynch.
If you're with UBS, what kind of mutual funds do you get?
Merrill Lynch. No, probably UBS.
Yeah. Vanguard, what funds do you get?
Vanguard. Yeah.
Fidelity?
Fidelity.
So that's right. So is that in your best interest? Probably not. So when someone is independent, like Decker Retirement Planning, we are able to work with any of the financial tools out there for our clients. So number 1, It's very important that you're dealing with someone who's independent. Number two is to deal with someone who is an RIA, a registered investment advisory firm. Not bankers and brokers are not RIAs. We are an RIA, registered investment advisory firm. The third one is the biggest one I'm going to spend the most time on, and that is a fiduciary is someone who is Series 65 license. Securities license is a Series 65, not a Series 7. A Series 7 does not have the disclosure rules and requirements of a Series 65. A Series 65 licensed fiduciary cannot take security commissions. It's all fee-based, above board, fully disclosed. Not true with someone who is not a fiduciary. Let me give you a few examples of what can be done and is done on a daily basis to you, the retiree, on a regular basis if you're not dealing with a fiduciary. Number one, variable annuities. Those are very expensive, 5 to 7% commissions right up front. The broker gets paid every year you own it. The insurance company gets paid every year you own it. The mutual fund companies get paid every year you own it. 3 layers of fees that usually add up to 5 to 7% a year before you take a dime, before you make a dime. And so we don't like them. We don't use them. Why would a true fiduciary recommend a high expense vehicle that underperforms the S&P and has no downside protection? We wouldn't. We don't. We hope people stay away from variable annuities categorically. Number two, and by the way, there's no disclosure of all those fees that I just mentioned if you're a Series 7 advisor. Number two is the highest commission product in the industry. It's called a non-traded REIT, real estate investment trust. In our opinion, there is zero reason to own these because of the tremendous variety of REITs that are publicly traded and are liquid on a daily basis. Non-traded REITs are not liquid for 3 to 5 years. Why? Because you, the broker, takes an upfront commission of 15 to 17% right up front that comes out of your principal. And it's not priced for 3 to 5 years. They say for liquidity, but it's to hide the shock that you'll have when you see the value of your account go down. So they want to give it 3 to 5 years to come back up. We don't like them. We don't use them. And again, this is another one that has no part in a retirement portfolio, in our opinion. Number three, and this really bothers me. You tell your advisor you don't want any upfront fees, no back-end fees on your mutual funds. They say, yes, sir, yes, ma'am. And then without telling you, and there's no disclosure, they attach C as in Charlie, C share mutual funds, which has a 12B1 fee that doubles your fees from 1% to 2%. It's so that the broker, the advisor, can get paid. And we don't like them. We don't use them. We warn you to check your statement to see if you have C as in Charlie, C share mutual funds. If you do, you need to have a very stern conversation with your advisor why he or she never told you that they doubled your fees and there was no disclosure. Nobody told you. Now I'm going to save the biggest for last. The biggest is, how do I describe this, Mark? Mark, if someone came to you and said, in my opinion, this is the slimiest of all products out there. Mark, have I got a product for you? How about if we pay you 7% guaranteed for 10 years and 4% for life? Does that sound good?
Sounds good.
Yep. So here's, at 65 years old, you're not, Mark, but let's assume that you are.
Well, I am in like 3 months, 4 months.
Okay. Well, so let's say you're 65, you put 100,000 in 10 years at 7%, 100,000 becomes 200,000. Now you're 75 years old and it's 200,000. You get paid 4% for life. 4% on 200,000 is easy math. That's $8,000. How long does it take for you to recoup your investment at $8,000 a year? You put 100,000 in. It's 12 and a half years. So now you're 87 and a half. You've gone 22 and a half years and you have not made a dime. Now, how do you feel, Mark?
I didn't need to make a dime because I had a guaranteed income is all I needed. I'm perfect, but probably not. I'm probably not. I'm behind, I guess, in that game.
What if there's 0.5% of inflation. You're way behind.
Yeah.
So yeah, you don't make any money. You might as well put it in a coffee can in your backyard for 22 and a half years. There's no difference. And so we don't like them. We don't use them. We warn people. These are called income annuities. We don't like them. We don't use them. We hope you stay away from them.
But
so
you do use some, don't you?
No, we don't use any life annuities. We don't use any
annuities. You do use some. Some you agree with. Most you do not. Is kind of what it seems like.
Oh, there might be, out of the hundreds and probably thousands out there, there might be like 5 or 6 that might work. And those are the ones that have no fee. Those are the ones that have average annual returns of over 8.5%. And those are the ones that allow you to pull income from them on a monthly basis with no charge. CDs can't do that. So when it comes to putting a portfolio together for retirees, we list that as an option that clients can use. And a lot of clients use those, but I'm warning people about staying away from income annuities, life annuities, income riders, and things like that, variable annuities. We don't like them or use them categorically. So those are examples of things that you can do if you are not a fiduciary. There's no disclosure rules. No one told you. And so we want to warn you. And again, I want to say, in my opinion, the most important decision you have to make as a retiree is whether or not you work with a fiduciary. A fiduciary is independent. They're required by federal law to put their client's best interest before their company's best interest, and they cannot do all those things that I just told you about that happen daily on a regular basis if you're not a fiduciary.
And don't you also have to tell about conflicting, points of interest that, if I do sell you this, I'm going to get paid by this, or I'm not, whatever. Because you don't take commissions, so you have to be upfront with everything that you're doing for the client, so there's no conflict of interest or something.
Yeah, that's right. So everything is fully disclosed, and clients actually even sign off on that. So here, what do you do when someone says that they're duly licensed? They've got both a Series 65 and a Series 7. Well, we want to warn you against such a being, because you don't know when they're talking out of the Series 7 side of their mouth and when they're talking out of their Series 65. So we hope that you jot a note that one of the things that you will do in retirement is to just deal with a fiduciary advisor, because they can't do those things that, in my opinion, are so horrible.
Now, I like the fact that you have to be upfront with your clients. And you can't do something that's better for Decker Retirement than it is for your clients. The clients they're number one. That's what your company's all about. How do you help your clients be in a better position, if that is possible? But you're upfront with everything that's going on. There's no behind the scenes dealing, like with mutual funds. I think there was a Ibbotson study that said 44% of all mutual fund fees are legally hidden. That's the kind of stuff you don't get when you operate with somebody that operates in the fiduciary responsibility. All of that is known to you. Your 401k at work, there's fees in it. No, there can't be. My employer loves me. They're not going to take fees. There are fees. So that kind of thing is what a fiduciary has got to be. Fiduciary responsibility that Brian and the team at Decker Retirement has, they have to be upfront about. So we got a lot to get to. We're going to get to tax strategies today. We'll finish up on fiduciary standard. What more does that mean? Because Brian was going to give us a definition. He went through a lot of things right there. We're going to talk more about it. But if you have questions about that, I wonder who we're working with. Are we working with somebody that operates under the fiduciary standard, putting our interest ahead of theirs? That would be something you'd like to know. 833-707-3030. If you'd like to sit down with the team at Decker Retirement, no cost, totally complimentary. 833-707-3030. More with Brian J. Decker of Decker Retirement Planning right after this.
Your story is unique, and so is the legacy you leave behind. Connect with Brian Decker at 833-707-3030 to start writing the chapters of your legacy and ensure it reflects your values and dreams.
Who likes uncertainty? Wall Street certainly doesn't. With near record inflation and partisan politics, there's a lot of uncertainty right now. What will America's future look like? What will your future look like? Will your taxes go up? Will your savings go down? For more than 3 decades, Brian Decker has seen uncertainty come and go. No matter what the future holds, Brian and the team at Decker Retirement can help you create a plan designed to preserve your finances in uncertain times. And it's not a matter of if those uncertain times will show up, but when. Call 833-707-3030 now to meet with Brian Decker and the Decker Retirement Team. If uncertainty is causing you to feel insecure, Brian Decker can help. Call 833-707-3030 and schedule your visit today. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us. Again, if you have questions, Brian went through the fiduciary responsibility that Series 65 and independent registered investment advisors operate under, where they have to put your interest ahead of their own. He walked us through that. 833-707-3030 if you have questions. Maybe you just have questions like, hey, Brian, I think we've got enough, but I don't really know. I'd like to find out, can we retire? When can we retire? Are we going to be okay? Are our loved ones going to be okay if something happens to us? Are we going to be okay really is a big question. 833-707-3030. 833-707-3030. No cost to you. Always complimentary chat with Brian and the team at Decker Retirement. 833-707-3030. All right. Another big thing. You got a lot of tax strategies coming our way in the next 3 segments. And I think the one that we all think about are Roth conversions. You're going to get into some that a lot of people won't even have heard of, I think, that you'll have to explain. But Roth conversions, we think, okay, that's tax-free, but it's not tax-free because we had to pay the taxes to get to that tax-free. But at the end of the day, it can grow after that and it's all tax-free money. That's a thing we're ahead of, but you always say that not everybody should do a Roth conversion. So this isn't blanket, hey, if you have a 401k or a traditional IRA, you need to move that money all to Roth. That's not what you're saying. You need to talk with somebody like you and your team at Decker Retirement before doing so, I'd imagine.
Right. There's a right way to use it. There's a funny saying in our business. There's so many, but one of them is nitroglycerin. Is it good or bad? And the answer is it depends on how you use it. So Roth conversions, there's 3 different general parts to the portfolio in retirement. There's cash, there's safe money, and there's risk. In our opinion, a Roth conversion, when you put Roth money to work, you would not put it in cash account. You wouldn't put it in an account that you're drawing from income. You would put it in the risk part of your portfolio. Why? Because a Roth account grows tax-free, distributes income back to you tax-free, passes to beneficiaries tax-free. There's also a 5-year provision that once you do a conversion, you can't touch it for 5 years. And that keeps it from really being prudent use of funds in the principal guaranteed side. And it's a waste if you put it in the cash side or money market side, where you really have a lot of bang for your buck with a Roth account. We have some very good risk managers. They're averaging in the high teens. If we take 100,000 and grow it to $1 million, Mark, are you happy with your account? If we take, I'm going to trick you a little bit here.
Okay.
If we take your IRA and grow it from 100,000 to $1 million, are you happy with us?
And we're still in the traditional side of the tax world?
Yep.
I'm probably happy, yeah, because you did grow my money. You've made my tax tax debt to Uncle Sam really go up. But, I mean, I've made money, but at the end of the day, I'm going to be paying a lot of it to Uncle Sam.
Right. Let's talk about how much. I want to give you numbers and illustrate an example of how tax inefficient the IRA is. I use superlatives very carefully, but you will see in about 3 minutes here that the IRA is, superlative intended, the most tax inefficient vehicle on the planet. So here we'll take someone 60 years old, $1 million IRA growing at 6% a year, Dutifully at age 73, they pay their required minimum distributions, and we killed him off at age 90. How much tax did he pay? Well, in his lifetime, he paid $676,732.22 in his life. But wait, there's more. Because of the Secure Act, which was passed a few years ago, you no longer have the ability to do stretch IRAs and things like that. Now, the rest of the tax on that beneficiary IRA that you pass to your kids has to be paid within 10 years. You don't have to pay it at 1/10 a year. You just have to pay the tax. You can pay it all in the last month of 10 years, but you just have to pay it. So in this case, there's another $718,496.14. So in his lifetime, $1 million IRA growing at 6% a year for 30 years, taxes owed on that $1,395,228.36, almost $1.4 million. Now, how much did his kids get? Did his kids get what the IRS got? No. The IRS got $1,395,000. His kids got $1,223,000. Now let that sink in. I'm going to say this again. $1 million IRA growing at 6% a year for 30 years, net of tax transfer to your kids, starting with $1 million, is $1.2 million. How much tax did you pay? Almost $1.4 million in tax. The IRA is the most tax inefficient vehicle on the planet. So let's go to what we are recommending you do, and that is use the Roth conversion, where these are key words here. We are proactively paying taxes now so that the account can grow tax-free, distribute income back to you tax-free, pass to your beneficiaries tax-free. Why would we do that? Well, we want the tax-free future growth, and there's 34 trillion reasons why tax rates have to go higher. So what we do here is we have same 60-year-old with $1 million IRA growing at 6% a year. We proactively pay taxes, in this case, on $225,000 first 3 years, and then $50,000 a year, so that by age 73, there is no required minimum distributions needed because there's no IRA there. We killed him off at age 90. How much tax did he pay? Did he pay $1,395,000? No. Paid $319,474.93, a savings of almost $1.1 million in taxes. How much was passed to the heirs? Was it $1,223,000? No, it was $4.1 million. This, ladies and gentlemen, is, in my opinion, the biggest tax saving strategy available to most all retirees. Now, why wouldn't you do it? Well, with the 5-year requirement on income, we don't do it if people are in poor health or if they're older than 75, things like that. And again, we want to make sure that we do it wisely. Wisely means that we are going to make sure that we try to maintain the tax bracket that they're in. So let me give you an example. Let's say that you've got $1 million IRA. And let's say that we've calculated your taxes for this tax year to be married filing jointly about $115,000. Well, $115,000 puts them in the marginal tax rate of 24%. So we don't go up to the 32% bracket until $191,000. So 191 minus 115 shows us that we've got 76,000 of what we call headroom, or ability to convert IRA to Roth without changing their tax bracket. Now we try very hard to keep people out of the 32% bracket and keep them in. Another big bracket jump is from 12% to 22%. But there's times when we make exceptions. We want to aggressively, over 5 to 7 years, convert that money that's in the risk part of their portfolio from IRA to Roth so that's growing tax-free, distributing income back to you tax-free, and passing to your beneficiaries tax-free. Now, Mark, same question. How would you like a $100,000 IRA converted to Roth, growing from $100 to $1 million? Is that better?
That is better. That is way better. My kids will love it.
Yep. Okay, so the Roth is, again, very important. There's a few exceptions, but that's something that I hope every retiree jots a note and make sure that they have it in their plan. There's a right way to do it and a wrong way to do it. And I just hopefully people have this podcast that they can dial up and make some notes on. Another tax strategy is a donor advised fund. A donor advised fund is where if you're giving to charity or your church tithing, what a donor advised fund allows you to do is to take 5 years of donations, concentrate them into one. Well, why would you want to do that? Let's say you have a tax spike for 1 year because you're exercising stock options. Well, donor advised fund gives you 5 years of deductions to offset that spike in 1 year.
Yeah, there's a lot of things in the tax world because I think a lot of us think, well, we don't control the tax rates and the tax brackets. That's certainly Congress doing all of that. But you do control how and when you pay your taxes. And there are a lot of options in the world to put you in a better position tax-wise because you think about it, 80% of Brian's clients basically come in with 80% of their money sitting in an IRA and a 401k that's a traditional. That's still going to be taxed to its fullest when you start pulling money out. How do you put yourself in a better position? Talk with Brian and the team because it's not right for everybody, but boy, it makes a lot of sense for a lot of people. But you don't want to willy-nilly go, oh, I got $1 million. I guess I'll turn it all into a Roth in 1 year. Well, you're going to have a big tax bill in 1 year. You still have to pay taxes. It's the idea of moving money and really in an orchestrated way, in a strategic way that Brian and the team at Decker Retirement can help walk you through that. 833-707-3030 is the number again. Totally complimentary. This could be one of the biggest things you ever do if you do it the right way. But get some guidance. Don't just do it yourself. Do it the right way. 833-707-3030. We're going to come back. We're going to talk about more tax strategies with Brian J. Decker of Decker Retirement Planning. Back right after this.
In the world of taxes, knowledge is power. Let the team at Decker Retirement Planning empower you with the insights and strategies needed to navigate the complexities. Dial 833-707-3030 to stay ahead of the tax game.
Have you noticed the market's roller coaster ride lately? Even a single day's dip can significantly impact your retirement. If the idea of shielding your nest egg from market volatility resonates with you, it's time to talk to the experts at Decker Retirement Planning. Call us now at 833-707-3030. Our unique approach aims to dial down the risk, keeping about 25 to 30% of your assets at risk, instead of the conventional 60-40 pie chart. At Decker Retirement Planning, we don't use a pie chart. We strive to offer you a detailed retirement income plan. It's about seeing the bigger picture, aligning your investments to your long-term goals, and making informed decisions. Whether you're new to retirement planning or already have a plan, we can help. Call Decker Retirement today to learn about the 6 things we do well for our clients that all financial advisors should be doing. Call 833-707-3030 today. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. Again, you can find out more on the website, deckerretirementplanning.com. A lot of great information there. But you can also go there if you would like to just learn more about Brian and the team. And you can also go there if you'd like to learn more about some of the things you need to understand about retirement in the financial world. There are 12 different things you can download on that website, deckerretirementplanning.com, under the heading of Safer Retirement Education. There are 12 different things you can download, including Brian's book on retirement, the Decker Approach book. So there's a lot of information for you there. That's all it's for. It's just for you gathering information about retirement. So go there, check it out, deckerretirementplanning.com, Safer Retirement Education. Grab what you want to learn more about. We're talking today, and I'm Mark Elliott. Glad you're with us. 833-707-3030 if you have questions of Brian and the team. Boy, I think we've got enough, Brian. I wonder if we can retire. Are we going to be okay if we actually retire? 833-707-3030. All right, we're talking tax strategies right now. Brian has talked about Roth conversions. obviously. Those can be great for some. They're not right for 100% of the people, but they're a pretty good idea for a lot of us. You need to do it the right way, certainly, because you're not going to get away with not paying taxes. If you're going to convert IRA money or 401k money to the Roth world, you do have to pay taxes on the money you're converting. But there's a strategy involved in that, and Brian and the team are here to help. 833-707-3030. He talked about donor-advised funds as well, but you got more tax strategies for us, don't you?
Yes. Let's say that let's say that they bought a building as a dentist and they've grown their practice 30 years, 40 years later. They paid $100,000 for the building. It's now worth $2 million. They really don't want to pay the capital gain on that. Let's say another person has the great fortune of buying Amazon and Microsoft and Google and Apple and Nvidia, and they've held those stocks for 15 years. Well, they have massive capital gains that they are looking at now. So whether it's real estate, whether it's stocks, if you're staring down some huge capital gains, there's another option that's available to you in a charitable remainder unit trust. There's a few steps that have to be taken. This alleviates you paying any capital gains. There's advantages and disadvantages to this, so I want to make sure that we cover both sides thoroughly. So in this case, we place let's say in this case, the real estate or the stocks in one or more charities, move them out of your estate into the charities, sell them. Those are sold outside of your estate, so you have no capital gains. You have a massive charitable credit to offset income taxes, or you can use it to move IRA money to Roth, like we talked about in the last segment for Roth conversions. But that credit is very valuable. And then right away, we start managing it with a two-sided strategy so that you have consistency of gains in that portfolio. The requirement is you've got to take a minimum of 5% of the portfolio as income coming back to you. And our objective is to avoid capital gains, but to place X, let's say that X is $1 million, $5 billion, you place X outside of your estate, and you pull back into your estate 3x, 4x, 5x over your lifetime. The trust is in the name of both spouses so that when one dies, the income continues. When both spouses die, the income stops because that money is held outside of your estate. The minimum that needs to be transferred and left to go to the charities is 20%. So the advantage is clearly you don't pay capital gains. The disadvantage is twofold. You're replacing income that's coming in as taxed as income, which is a higher rate than capital gains. And also the money is held outside of your estate. So at the untimely death of both spouses, that income stops. So if you were to have a horrific situation where both you and your spouse were to pass away in a car accident soon after you did this, that money is outside of your estate, does not get passed to your kiddos. This is used carefully and wisely with people that are younger, ideally under 70, in good health, married. The risk is much higher if you try to do it as a single individual because there's just one life to pull this money back in your estate. The ideal is to avoid capital gains, use the charitable credit, and take X outside of your estate and pull 3, 4, or 5X back into your estate. That's called the charitable remainder unit trust. The next one is the qualified domestic relations order, or a quadro. There's an unhappy quadro where in divorce, a judge separates the estate, usually 50-50, and that's an unhappy quadro. Unhappy for both. The happy quadro is when there's an age difference in spouses of about 10 years or so or more. And what we do is we take the 401k of the older and split it in half and put half to the younger spouse, giving us more time to convert from IRA to Roth. So that it gives us a bigger runway. Now, as soon as the spouse converts or moves the 401k into an IRA, the quadro's off the table. It cannot be done with an IRA. It can only be done with a 401k. But that's how we use the quadro. Now, what about the irrevocable life insurance trust? This is used for people that have state estate taxes or federal estate taxes. Now, the federal estate tax is very high right now. It's about 22 million per person. So if you're married, your estate needs to be over 44 million before you have exposure at the federal estate level. But there's smaller state estate taxes that are at the state level. For example, one of our markets, the state of Washington, is one of 23 states that have state estate taxes. What does that mean? That means that when you and your spouse die, any amounts in your estate, this is everything, the value of everything, any amounts over 2.2 million per spouse, 4.4 million per couple is going to be taxed at the state level at 20%. So a $5 million estate is going to owe $400,000 in estate taxes at the state of Washington. Now, half of our clients, Mark, have the attitude of, what do I care? I'm dead. We're both dead. Whatever the kids get net of the estate taxes, more than we ever got. So who cares? The other half of our clients say, no. After a lifetime of paying taxes, I would roll over in my grave if I knew that the state of Washington took another chunk of flesh just because they could. So I'm going to make sure that I do some planning to make sure that that doesn't happen. So how do we do it? Well, there's a couple of things. First of all, we try to make sure that in the client's trust, we have an AB credit. An AB credit means that we have the creation of a survivor trust and a decedent trust at the death of a spouse, so that the $2.2 million credit can be activated and used. Without the AB credit, one spouse dies, there's no credit. Now the $5 million estate doesn't pay $4 million. Now the $5 million estate has only a credit of the last to die spouse of $2.2 million. So they have $2,800,000 at 20%. That is not $400,000, that's $560,000. So we want to make sure that in the trust, we use the AB credit, the survivor and the decedent trust split to use the $2.2 million credit. And also we want to make sure that we value or estimate what kind of tax liability we're looking at. And then we buy a second to die whole life policy outside of our estate that comes due in cash, tax-free, when both spouses are gone. Now, the kids, if there are children, pay the premiums through a crummy provision transfer. They have gifted money coming from the parents to the children. The children have the option to buy a car with the money, or they're smarter than that because this is preserving their inheritance from estate taxes. So they dutifully pay the annual premiums. And when mom and dad are gone, that money to pay the state of Washington, state or federal estate tax comes due right away, tax-free, and is there to pay the estate tax. It's very inconvenient to look for places to pull an extra $400, $600, $800 million out of the estate. Do you sell real estate? Do you sell stock positions? It's very inconvenient. So we want to make sure that our bases are covered and have the ILIT, the irrevocable life insurance trust, in place. Some people have made the horrible mistake of buying a second to die policy in their estate. Well, now they've compounded the problem by having $800,000 in life insurance on top of their $5 million estate. Now their taxes have gone higher because the ILIT was set up incorrectly. So this needs to be done right. But that is the ILIT. It's a tax strategy to avoid state and federal estate taxes. The next strategy is for people who own rental real estate. If they own rental real estate, we love it because it's a diversified income stream. And what we offer is to hook them up with this strategy where instead of 27-year depreciation on their rentals, they can move it to 10 years. And what that does is in a 10-year cost segregation strategy, their income stream from rent is now tax-free. Why is it tax-free? It's because when you pay $2,500 for a cost seg study per rental unit, they are accelerating the depreciation you can take on the foundation, which is different from the windows, which is different from the roof and the chimney. All these things are segmented and able to have accelerated depreciation. So you've got a big enough tax offset so that your rental real estate income is tax-free. The problem with that is after 10 years, you need to do a 1031 and wash, rinse, and repeat and do it all again. It only works for 10 years, and then you've got to start over again. But cost segregation is a favorite of people who want tax-free income from their real estate.
So this is the opportunity you have to find out more about this stuff. I think the challenge is a lot of these things that Brian went through, and I'm 64. I hadn't heard of some of these things, and I probably don't have the funds to make a difference. But I think it's really important to, especially the high net worth clients at Decker Retirement, understand some of these things. And Brian and the team are certainly here to help. But even if you're just a retiree, you're trying to make a living, you're trying to enjoy your retirement, there's strategies out there that maybe you're not aware of, and Brian and the team are, that might make a big difference in your retirement success, if you will. 833-707-3030 is the number. No cost to you, totally complimentary. 833-707-3030. 833-707-3030. Might be one of the more important phone calls you make, I think, to the team at Decker Retirement. 833-707-3030. Back with our final segment of today's Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning.
As the weather warms, the open roads begin to beckon. If you've been getting the itch to travel, call Brian at 833-707-3030 to make sure you have enough saved to keep the winds of adventure blowing in retirement.
Have you noticed the market's roller coaster ride lately? Even a single day's dip can significantly impact your retirement. If the idea of shielding your nest egg from market volatility resonates with you, it's time to talk to the experts at Decker Retirement Planning. Call us now at 833-707-3030. Our unique approach aims to dial down the risk, keeping about 25 to 30% of your assets at risk, instead of the conventional 60-40 pie chart. At Decker Retirement Planning, we don't use a pie chart. We strive to offer you a detailed retirement income plan. It's about seeing the bigger picture, aligning your investments to your long-term goals, and making informed decisions. Whether you're new to retirement planning or already have a plan, we can help. Call Decker Retirement today to learn about the 6 things we do well for our clients that all financial advisors should be doing. Call 833-707-3030 today. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. Again, DeckerRetirementPlanning.com to learn more under the heading of Safer Retirement Education. 12 different things you can download right there for your information. No cost to you. It's just there for your really knowledge and your education, if you will. DeckerRetirementPlanning.com, Safer Retirement Education. One thing that you can get if you want is Brian's book on retirement, the Decker Approach book. If you have questions, you're going, wow, Brian's covering a lot of ground today in this tax world. I don't even know what I should be doing. This is an opportunity to say, hey, look, I'm confused. I'm not sure if some of the stuff Brian was talking about is right for me or not. Some of it sounded really good, I think, for me, but I'm not sure. 833-707-3030. 833-707-3030. All right, Brian, you covered a lot of ground. You got 12 minutes to knock it all out, to wrap it all and bring it all together.
All right, we've got a few more tax strategies to cover. Let's say that you've got a situation where you've got a massive capital gain. You don't want to use a charitable remainder unit trust. You love the stock. You want to hold it. But remember, retirement planning is about cash flowing your assets. So you've got a huge Microsoft position. You've got a huge Boeing position or Costco or Starbucks or fill in the blank, Apple, Amazon, whatever it is, NVIDIA, and you like the stock, you like the company, it's a huge part of your retirement portfolio, but you don't want to sell it. What do? How do you monetize or cash flow that? Well, we have a company that we use that sells covered calls. You can tell them if you want or don't want to lose any of the stock, and they create an income stream for you off of that position. So that's something that clients really like. Another one is called a GRAT, a grantor remainder annuity trust. And a GRAT is something that we just talked about with a client a couple weeks ago. They were down in Florida, and he's about 65. He wants to retire. He's got adult children, and he's starting a new company. He's got a passion that he wants to he's got an itch he needs to scratch and start a new company. He knows it's going to be profitable. We told him to start it in a GRAT. Move all the profits down to your kids. Your estate is already at 30 million. Why do you want to create another 10 to 15 in your portfolio? For tax reasons, that makes no sense. So he opened a GRAT, started his company in the name of his children. All that growth is taxable in their estate, not his. Their estate is much smaller than his. So that's a grantor remainder annuity trust, a GRAT. Let's say that your children, Mark, tell you, hey, mom, dad, we're good, don't need any inheritance from you. So you think, oh, I'll just pass it to the kids. Mark, guess what the tax is for a generation skipping event of sending your assets down to your kids and as a beneficiary?
I would have no idea on that. I would think not as much.
Now think that you're taking a whole lifetime of tax and missing it by sending it down to the grandkids. It's called a generation skipping tax, and it's 48%.
I guess it went higher is what it did.
Yeah, 48%. So the way around that is to use a dynasty trust. A dynasty trust is perpetual and per stirpes. Perpetual allows you to put how you want the trust used, and it blesses the lives of your grandchildren and their children and their children. It's a legacy account, and it's per stirpes, meaning it's bloodline only. And that means if there's a divorce, that account can't be split and sent over to the ex-spouse. So with a dynasty trust, the most popular way that they complete that trust is to say you're rewarding responsible behavior. So X% of the trust pays for tuition if they go to college. If they don't go to college, how much do they get, Mark?
How much do they get?
They get zero. Let's say that you get X% of the trust if they get married. If they don't get married, Mark, how much do they get? They get zero. And if X% of the trust pays for the first child, if they have no kids, guess how much they get?
Zero.
So you're incenting any behavior that you want. Those are three popular examples of how the trust pays out to your children and their children and their children and their children. But you create the trust while you're alive. You list it as a beneficiary. So let's say you've got a $10 million estate. You've got two children. Well, instead of the kids getting 5 and 5, you create the dynasty trust, and now you list it as a beneficiary. You can state how much they get. Let's say it's $3 million. So then the children get the rest. So $3.5 million go to the two kids, $3 million goes to the dynasty trust. Everyone's happy. So that's how the dynasty trust works.
So if you have questions about any of those tax strategies, and Brian went through a lot of them, 833-707-3030. Do they make sense for us? Do they make sense for me? I don't know. Brian and the team doesn't know until you reach out. 833-707-3030. All right, you've talked a lot of different tax strategies today on the program. How about now maybe bring it all together, Brian, and talk about how these strategies come together in the distribution plan, the safer retirement process. How does the tax strategies maybe come together in that distribution plan?
Good. So if you have a pie chart and you're being told by your advisor that a pie chart is your retirement plan, that would be a major problem because, Mark, in my opinion, that's the number one reason why the number one fear of people over 65 is running out of money before you die, because they're guessing. They're looking at a pie chart and being asked to figure out how much money they can draw for the rest of their life. Well, you can't can't do that. No one can look at a pie chart and make that calculation. Some try, they use the 4% rule. Well, major problem. I'm going to quickly talk about some of the major problems with the typical retirement strategies from bankers and brokers. A pie chart is not a plan. Since we're a math-based firm, we use a distribution plan, which is a spreadsheet showing all the separate revenues and income streams from the client. Do they have a pension? It goes here. Do they have Social Security for each spouse? It goes here and here. Do they have rental real estate? It goes here. Do they have portfolio income? It goes here. Now it's on the spreadsheet. It shows the actual numbers each year. We have estimated growth, and our clients don't have the number one fear of running out of money before they die, because every year it's updated and they can see net of tax how much money they can draw for the rest of their life. It's a real plan. It's not a pie chart, which is just to show you what portfolio percentage allocations you've got. It is an actual retirement plan. So you take all of your income, you total it up minus taxes. That gives annual and monthly income with a COLA to age 100. What if you wanted to turn your income up a year and do some major traveling? What if you wanted to turn it down a year because you're just bumping up against a tax bracket that you don't? We can do income planning, tax planning. We do Roth conversions based on your income. We can easily see what kind of income you've got. So number one is to have a plan, and a pie chart is not a plan. Number two is you don't put your safe money in a bond fund. Bond funds lose money when interest rates go up. From 1940 to 1980, the 10-year Treasury went from 2% to almost 15%. That was an interest rate up cycle. Then from 1980, the 10-year Treasury for 40 years declined to August of 2020, where we hit 0.47%. Well, since August of 2020, the 10-year Treasury has gone from 0.47 to 4.5, where it is right now. The average person in bond funds has lost over 30% in the last almost 4 years now. So that's not a good strategy. There's 34 trillion reasons why we believe that interest rates may go higher than where they are now. The calls from people in the stock market were for 5 interest rate cuts from the Fed in January of this year. Now we're towards the middle of the year, and maybe we get 1 or 2. So, and the Fed rate is different from the open market rate. The open market rate determines whether you make or lose money in bond funds. Bond funds have interest rate risk, and we've started a rising interest rate cycle. We hope that you do not use an advisor that tells you to put your safe money in bond funds. They lost 20% just in 2022 alone. So we hope that you stay away from anyone who tells you to use a pie chart for a plan. That's not a plan. And to put your safe money in bond funds. Also, we believe that we've entered a flat market cycle. There's been 4 times that the S&P ever has traded above 30 times trailing earnings. 1929, markets were flat for 17 years. 1964, markets were flat for 18 years. 1999, markets were flat for 14 years. Well, November of 2021, we hit 32 times trailing earnings. History has been 100% on this. That means in the next 10 to 15 years, if you have a buy and hold strategy, buying and holding stocks, mutual funds, indexes, or ETFs, if your advisor is telling you to do that, history is showing that you should expect a 0 return for the next 10 to 15 years. Don't do that. Those are big differences that we have with the banker broker strategies.
So the key really at the end of the day is you. And what do you need for your retirement to be a great success? Well, you need to have a plan. You need to have a strategy. And tax strategy is certainly a part of that. But at the end of the day, it's about you. How can Brian and the team at Decker Retirement help you have more confidence and certainly more clarity into your retirement? And all these options that are out there, they're not right for everybody, but some of these options are right for you. Don't know which because we haven't chatted with you yet. If you'd like to talk with Brian and the team at Decker Retirement and try to figure out some of these tax strategies, do they make sense for you? Really get a retirement plan, income, investment, taxes, healthcare, legacy planning, Social Security decisions, Medicare decisions. Call the team at Decker Retirement Planning. It's 833-707-3030, 833-707-3030. 3030. And again, this is totally complimentary to you. 833-707-3030. Brian, thanks for your time. Enjoy the rest of the weekend. We'll chat again next week.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.
Who likes uncertainty? Wall Street certainly doesn't. With near record inflation and partisan politics, there's a lot of uncertainty right now. What will America's future look like? What will your future look like? Will your taxes go up? Will your savings go down? For more than 3 decades, Brian Decker has seen uncertainty come and go. No matter what the future holds, Brian and the team at Decker Retirement can help you create a plan designed to preserve your finances in uncertain times. And it's not a matter of if those uncertain times will show up, but when. Call 833-707-3030 now to meet with Brian Decker and the Decker Retirement Team. If uncertainty is causing you to feel insecure, Brian Decker can help. Call 833-707-3030 and schedule your visit today. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.